When doctors invest in syndications, it's like embarking on a thrilling adventure, but it's not without its risks and challenges. To navigate this field successfully, one needs a good understanding of the capital stack. This financial concept serves as a guide helping investors weigh their risk, exposure, and anticipate potential returns in a real estate investment. Whether you're a seasoned investor or just dipping your toes into the real estate waters, your position in the capital stack is vital, as it dictates your priority in the order when it comes to claims on the deal's capital. Hi there, this is Harry Nima Segara from Nima Equity, and today we'll discuss the capital stack, explaining its various layers, including senior debt, mezzanine debt, preferred equity, and common equity. What is the capital stack anyway? The capital stack in real estate is the structural blueprint of your financial investment. It delineates the hierarchy of capital sources employed to acquire a property, clarifying who holds rights and in what sequence to income, profits, and even the property itself in case of foreclosure. Think of it as a visual representation similar to a layer cake, highlighting the diverse forms of capital involved in the deal. Essentially, the capital stack comprises distinct tiers within the deal's financial structure, outlining the order in which investors are reimbursed from generated profits during the holding period and specifying the rights to repayment in the event of a default. Number 1, the foundation, senior debt, the bank or lender. At the base of the capital stack lies senior debt, forming the bedrock of the structure. Despite its position at the bottom, senior debt holds the first position, leveraging the property as collateral. This means that should the property underperform or fail to generate sufficient cash flow to cover its debt service or mortgage, senior debt investors, the bank or lender, are the first in line for repayment. In exchange for this lower risk, senior debt typically yields the smallest return on capital. It often constitutes a significant portion of the total project cost, roughly around 60 to 80%, although this can fluctuate depending on factors such as the property's risk profile, market conditions, and the borrower's creditworthiness. Number 2, stepping up, mezzanine debt. Mezzanine debt occupies a level just below senior debt in the hierarchy, securing a higher return but at the cost of increased risk. Unlike senior debt, it isn't backed by the property itself, but by a pledge of ownership interest. While the mezzanine debt holders possess limited foreclosure rights, these rights are typically constrained by the senior debt agreement. Mezzanine debt investors sometimes share the profits too. Number 3, the middle ground, preferred equity. Preferred equity rests in the middle tier of the capital stack, sandwiched between debt holders and common equity investors. These investors demand a higher return compared to debt holders, but generally expect lower returns than common equity holders or passive investors. Preferred equity often enjoys benefits like a share of appreciation and profits in the form of distributions, making it somewhat of a hybrid between common equity and mezzanine debt. They typically share in some upside and may receive recurring payments, although the terms can vary. Preferred equity can be categorized as hard, requiring payments regardless of cash flow, or soft, conditional on sufficient cash flow. And number 4, the apex, common equity. Common equity occupies the highest position in the capital stack, making it riskier but potentially more rewarding. They receive distributions from the property's profit, although these distributions are not guaranteed. 2 types of common equity. Class A would likely be the passive investors or limited partners in a capital stack. These limited partners are likely participating in capital returns and would receive a portion of the profit after the sale too. The highest level, Class B. These are likely the general partners or syndicators who carry the most risk and are last on the priority list. Importantly, all common equity investors have ownership rights in the property, pledging it as collateral and adhering to the rules of those lower in the capital stack. However, if the property depreciates during the holding period, common equity investors may not receive distributions or profits upon liquidation, potentially risking part or all of their principal. Often, common equity comes from the project's sponsors or general partners, signifying their commitment by investing their own money. It's worth noting that potential returns for common equity investors typically have no upper limit, making it both high risk and high reward. In conclusion, in real estate investments, risk is an ever-present companion. Understanding the capital stack and your place within, it's important in assessing the risk-to-reward ratio for your anticipated returns. While investors' risk tolerance vary, many find themselves positioned at the common equity or preferred equity levels of the capital stack. By understanding the capital stack, real estate investors can make informed decisions, effectively balancing risk and reward in their journey of finding profitable property investments. If you're interested in learning more about real estate, and more specifically syndications and how they can help you diversify your investments and build wealth, join the Nima Equity Doctors Investing Club today. You'll find the link down below in the description. Also, if you have any questions or want to share your own experience, drop a comment below. Together, let's build a thriving real estate community. And finally, if you like this video, hit that like button below, share with a friend, and be sure to subscribe. I'm Harry Nima Segara with Nima Equity. Thank you so much for watching.